Oh, hello. Welcome back. Welcome back to the continuing lecture in business math. Um, Continuing from our last class, we're going to discuss the um, accelerated depreciation method, and of the two accelerated depreciation methods, we're going to be discussing the partial year depreciation of the uh, rule of 78 or sum of the digits method. And if you remember, just to jostle your memory, in our last class, we did the um, sum of the year's digits method, which is also called AKA rule of 78, because literally, um, if we uh, if we have 12 months, right? I don't want to go back to the uh, same explanation over and over again. But if we have 12 months, how we allocate our weight over 12 months in a neatly declining pattern, right? And to do that, uh, we can simply sum all the digits from 1 through 12, which would sum to 78, and allocate the uh, that digits in a decreasing or descending pattern as the numerator in the weight, right? So that method, right? That technique is called sum of the year's digits or rule of 78. I mean, it doesn't have to be 78 because 78 is only the result of 12 months or 12 periods, right? But if you have like 5 periods, 6 periods, 7 periods, I mean, we are talking about number of years in depreciation, right? So uh, uh, 78 is just a stylized 12 period case. So it doesn't really have to be just 12 or 78, but the basically the technique is the same. So and we saw how you saw how I did that in the last lecture, in the last video. So I'm not going to go over that again. But then, as I said, uh, more realistic issue arises, right? Or a practical issue arises, which is about partial year ownership of the asset. As I said, not all of the assets are purchased, at the beginning of the year and held for the full year in the first year. From the second year, it's going to be held for the full year, but in the first year, it is purchased, right? Because it can be purchased at any point during the first year. But suppose we usually use quarterly, right? All the financial statements are basically on a quarterly basis, right? Of course, it can be monthly, but a a standard uh, a standardized operating period is a quarter because quarterly earnings, quarterly reports, and everything is basically quarterly. right? So suppose you don't have to exactly buy the asset uh, exactly at the beginning of the second quarter or third quarter. But if your company purchased the asset sometime around, like the beginning of a second quarter, then we use the second quarter, beginning of the second quarter, which is April 1st. The asset doesn't have to be really purchased on April 1st, but let's say it was purchased March 31st. Then pretty much April 1st is the starting point. And even if it was purchased on around like uh, uh, April 15th, right? Still, the starting point is the second quarter, right? Okay. So, with that understanding, let's take a look at the next example. And in this example, it isn't exactly verbalized here, but I will put it here. It's not exactly verbalized, uh, asset was purchased on, let's say, and that's like we can count it from the April 1st, the beginning of the second quarter. And then, in the first year, this asset was held for 3/4 of the first year, right? 3/4 of the first year. And our next question is then, so the purchase cost of this asset is 18,000. That seems, okay. Salvage value seems rather too high. So let me make the salvage value like $120. It seems rather, okay. 2,000, that's a lot. Let's make it even 125. Okay. And of course, these things, they don't have to be here, right? I will get to that later. Now, so we know the depreciation rate normally is like this, but we don't need that, right? Because this is not a straight line depreciation. We really don't need this, right? So I'm gonna delete all of that. Mm. Oh, wait. I'll just delete. Delete shade columns and no, what did I do? I did cells, delete cells, shift cells left. Okay. Now, so then if this is a 4-year asset, right? What I would do is simply I will need these digits for years, so I'm not going to do anything, but instead I will copy this. I'm not going to make the change directly there. I'll copy that and paste it there and simply uh, reverse that, right? Sort it in descending order. And then because these columns are adjacent next to each other, when you are sorting a data range or a set of data, And Excel normally considers adjacent cells as related data. So when this is being sorted, then in a descending order, it's going to wonder whether the other column must be sorted as well. In this case, you don't want this to sort it. This case, it doesn't need to be sorted this way. So it doesn't need to be sorted in descending order. So you don't expand the selection. You just continue with the current selection. Okay, continue with the current selection, and I clicked the wrong thing. So okay, now it's sorted in reverse. So now we can find the depreciation rate. Of course, I already got the total here, right? Uh, because 1 through 4, I got the auto sum there, and I'm going to divide that by that, okay? And lock, there you go. And I'm going to give it 2 decimal places, and then I'm going to drag it down. Okay, here I already have auto sum built in there, right? So it's going to automatically, now. So you might think, okay, so in the depreciation piece, right? I'm going to calculate the depreciation, but let me do it this way. I'll find depreciation base here first. Depreciation base, so that will be easy. This minus this. Okay. So our depreciation base is like that. So normally, if this is a full year thing, right? Full year depreciation, you would simply multiply that by this, right? You would simply multiply that by, okay? But then think about it. And we didn't have the asset. We didn't have the asset for the full year in year 1. So what do you need to do? I mean, how many months or how many quarters did we have it? We had it for 3 quarters, right? So then all you need to do is, okay, I'll do 3 quarters, right? You make that adjustment there. Okay. So there you go. So then you think, oh, okay, so I'm gonna drag. No, you cannot drag it down like that. Why? Because in the second year, you didn't have it for 3 quarters of time. But let's take a look at this. First, you had this asset for the full year in the second year, right? But then in the second year, you would apply 30%. But look, what's the point of accelerated depreciation? Hmm? The point of accelerated depreciation is all about really trying to get the maximum, right? Maximum possible amount depreciated, right, or write off the maximum possible amount as early as possible. That's the whole point of accelerated depreciation. Then, if you apply 30% for the full year, then it completely defeats that purpose, right? It completely, just throws throws that purpose down the drain. So, what do you do? I mean, how else, what can we do about that? I mean, can you not depreciate it by 30% for the second year? No. You should remember um, we had 1 quarter in the first year that we didn't have, right? But that one quarter uh, can be that 1 quarter will be used in the second year. What does that mean? I mean, we we didn't have that 1 quarter to which we could apply 40%. So that 40% is wasted. 40% for 1 quarter was wasted in year one. So we would like to salvage that 40% in the second year. So how? For that 1 quarter, for the first quarter of the second year, we're going to use that 40%. Makes sense? For the first quarter of the second year, we're going to use that 40%. But if that's the case, it's not what do we need to do? We will need to use C29 and multiply that by quarter, and then C30 will be applied to 3/4 of the second year. Make sense? Mhm. And then from there on, it's easy. All you need to do is simply drag it down. So in the third year, that pattern repeats, right? That pattern, that structure repeats. But then in the last year, fourth year, it's going to be a problem if you don't look. The whole point is now in the last year, the idea is fine, but then I mean, it's the recurring, repeating logic. But then uh, let's think about it. If this is correct, I mean, if we did it right, then we should have the salvage value as the book value in the last year, right? Well, let's see if it is. We can check, right? So I'm gonna. And what is book value? Book value is always the purchase cost. So I'll lock it minus accumulated depreciation. Ah, I'm sorry. It's uh, still too early to still too soon to have. So this is cumulative depreciation. So the cumulative depreciation is in year one is just itself. From year two is uh, that plus the previous year. There you go. And then you drag it down. Okay. And then the book value is what? The book value is always the purchase cost, and you gotta lock it, minus the accumulated depreciation. Okay. Then you drag it down. And what do you see? Is this the salvage value? No, it's not the salvage value. So if it's not the salvage value, then you didn't fully depreciate it, right? So then that's very sloppy. I mean, some people don't make, uh, you know, don't make a big, deal out of this. Some people, make a very, but it is wrong, right? As long as you don't reach the salvage value, or you don't end up in salvage value or zero, that means you didn't fully depreciate it. So that is, fundamentally wrong for depreciation schedule. So what does that mean? You need to make an adjustment in the last year. And the adjustment, I'm sorry, here is, so you understand we have to use uh, 1 quarter for, we have to apply 20% for 1 quarter. But since this is the last year, you don't apply 3 quarters of a year, because this is the last year. It has to end here, right? So it's not 3 quarters. You just give it full year, 10% to the full. You apply 10% to the full year. Of course, that 20% for extra quarter. That is for extra quarter, right? But once you do that, what do you see? The book value is exactly the salvage value, right? We got it right. Okay, book value is exactly the salvage value. Now, so if this is the, let me insert a couple of more rows here. Now, in this example, this was relatively very simple or short period. Well, even if it is a longer period, it's not a big deal. Let me try. Let's try different examples, like different data. Much more expensive asset, like 218,000. The scrap metal value, salvage value is something like 325. And then life, let's try. Oh, 10 years. Let's try 10 years, right? And then I will need to do what I'm going to have to do. I'm going to, for the weight, and I will sort descending, right? I'll just, limit it to the current selection, sort, right? I got that. And then I already, have, okay, sum of auto sum. It shouldn't be like this. It should be from, right? That will be then what? It's going to be 55, right? Also, you can just, you can just drag it to the right, and it's going to, okay, it's the same formula. So, okay, there you go. Oops, why? 20, see 29 through. Yeah. And oh, it's all, so it's correct. It's only because we have only 4 terms, and once we drag it down, it's gonna fill, completely. It's gonna add a sum to 100%. Now, depreciation expense, we know. All we need to do is now just doing it like that. And here we're gonna, because this is not the last year, we cannot just apply the full year here. We're gonna have to make it 3 quarters, right? So I will copy and drag it until and finally we will need to make adjustment here. But and cumulative depreciation, right? And then for the last year, we'll just apply. Okay. And then the book value will be exactly the salvage value. So we got it. We nailed it. Now, but this is not why I did this example again. I mean, it's just a longer, time period, but nothing, fundamentally, as far as the mathematical logic goes, nothing fundamentally different. But what I wanted to do was making this automatically, right? Purchase point, right? If this is the purchase point, right? So I can put like T1, T0, T1, right? And so let's think about it. I think this is not really necessary. It is necessary. Life 10 years, something has to give you what life, service life is. What I'm trying to do is, okay, let's get rid of this. I'll name example number 2 to be there. Oh, that's to be. All right. Now, so what I can do is, I'll call this T0. T1. And in T0 is basically 0. April 10. T1 is 12/31. Okay. And then we can turn it into quarters, right? So what is the T in quarters, right? And in quarters, T just I would call it not T1, but just what should I call it? Yeah, T1's fine. But you understand what I'm trying to do. I'll just since we are counting only the quarters, let's just make this April 1. Okay. Okay, it's not. Although it was actually purchased on April 10th, but if you're counting it by quarters, April 1st is okay. So here, all you need to do is this minus this, right? course, we'll have to put it into a divided by 65, right? Because actually, it will count all the calendar days are counted as days, right? So if I do that, it's going to give me, you know, 0.750 years, right? Now, which is, if you, and then if you multiply it by 4, right? So you multiply the whole thing by 4. Of course, you don't have to, that's 3/4, but this is not what I'm, 3/4. So, this is already, 3/4. So I want to turn it into a, and here I will need t and 1 minus t, which is literally, minus this. And I will need to express this in fractions. So numbers, I will go to fraction. Okay, now see, neatly it's done. So what am I gonna do? What I'm trying to do is instead of you see what I did here? Instead of I wrote in actually 3/4 manually, right? Instead of doing that, I'm gonna point to this, right? And hit F4 to lock it. And then here, so did anything change? It changed slightly because, yeah, it changed slightly because this number, although it's showing like, 3/4, right? 3/4, but it was not exactly like 0.75. And for that to be 3/4, it should be exactly 0.75, but it was slightly more than 0.75. So it's natural that it will change. And here I'm gonna give it this, hit F4. Oh, I'm sorry, what did I do? It's gonna be, yeah, this, and I'm gonna lock it, and 3/4 will be, right, replaced by that. I'm gonna lock it. There you go. And then I drag it down all the way. In this one, I will simply remove this and hit enter. And what happened? Right? I got the salvage value at the end of those 10 years. Right? Isn't it wonderful? We don't have to. One thing we could do it that way as well. In other words, I could simply. If you think it is too onerous to do it this way, you could simply put 3/4 there. But then again, I don't like, as long as you're using a computer, right? What's the purpose? The purpose is to make it automatic, right? And if you have to intervene every time, I mean, by manually typing in anything, any number, any numerical value, and I told you that's called hard coding. And um, I've been stressing this over and over. Hard coding, try to avoid hard coding as much as you can. You don't want to hard code anything into it because what if, I mean, you cannot handle the situation if it is not, if it is hard coded and if some conditions, change, then the model doesn't automatically adapt to the uh, changing environment, right? So instead of so the benefit of this, think about it. What if it will it will adapt to a new environment? Let's say, what if the asset was not purchased on April 1st, but let's say it was purchased on it will automatically adapt, with to an exact degree, right? I mean, even by um, April 15th, right? That's going to automatically adapt, right? It doesn't have to be, oh, artificial, artificially, by the quarter. I mean, of course, everything is uh, basically the balance sheet, financial statements are quarterly, but we can give it more precision, right? And still, as long as we end up with the salvage value at the end, we did it. We, depreciated nicely. And even if it is, let's say, I mean, once you build it this way, it doesn't have to be only April. It doesn't have to be April. Anytime, like, let's say July 11th. So automatically adjust, and you come to salvage value. What about, okay, uh, something like March 13th. Voila, right? And these are fraction of years, right? If you bought it in March, around March 15th, uh, your time time remaining, I mean, um, in the first year, 4/5 of the year you had the asset, but 1/5 you didn't have the asset. Then 1/5 will move on to the next year and will depreciate, uh, bring the depreciation, accelerate the depreciation of the second year by 18% for at least 1/5 of the year, right? So makes sense. This is how we can. Uh, so okay. uh, Instead of doing it like this, asset was purchased at T0. Asset was purchased at time 0, right? Or let's call it. I can call it also. Okay. Let's call this time 1. Call this time 2. Okay, because time T0 sounds like beginning of the year, right? I can call it time 1, right? Right. So is everyone okay with this? I mean, this is a this is compared to like time value of money. This is much simpler model, but it has a lot of more pliable, right? you can bend it, or you can uh, flex it, you can bend it, you can tweak it. I mean, there's a lot of room for tweaking here. And uh, still, as long as you get the salvage value right at the end, you're good, you're okay. Try, and even if you change the salvage value, let's say the salvage value is, like 170, 155. Okay, look, right? So wonderful, huh? Now, uh, and another thing here. So in the so a little, once again, I've been telling you, some housekeeping is necessary, right? Always, neat housekeeping is always a virtue. It's commendable. Okay, neat housekeeping. Uh, if possible, I'm gonna, like, redo the whole thing, so it's not difficult. Simply, no no border, no border, no border, and no border everywhere. And then you can put everything into, like a, okay, now, but let me do this. Just, simple. It's just, you might say it's a cosmetic thing, but it's important, right? But and let me show you. Um, if there's a problem in the homework like this, you would most likely to just copy this and, template, and reuse it. But then think about it. The problem arises here. I mean, for example, uh, you have to adapt the model to the new environment. So let's say this is the template, but in the new example, the new example had, let's say, 7-year life. New example had 7-year life, has 7, right? And then let's say the rest of them are pretty much the same. And then some people would, oh, if it is, we do it only up to uh, think about it. If it is year 7, everything has to end in year 7. That means you won't have, uh, you will have to delete uh, everything below year 7. So, what merge cell? Was there a merge cell? Okay. Um, okay. So that means then this will have to change, right? Currently it's 40. So if it is from here to here, it's 49, right? And you can't leave it like this, right? Obviously, right? Uh, because here it's pointing to, okay, B 36. How can it be okay? It's changed. Okay, so it's automatically it has automatically adapted to the new environment, which is a good thing. And still, they all sum up to 100, right? And then everything has then, like, it's got, uh, it's adapted automatically to the uh, new conditions. Now, the last thing, so check if everything is correct. So in the first year, this 20% is applied only for 4/5 of the year. And then 1/5 will be, right, 20%, and 4/5 will be 18%. And then, it keeps on going like that. But finally here, right, in the last year, you will need to give 8% to the whole year, but you still have 1/4 of a year that gets depreciated at 10%. So we'll need to get rid of this. And then the minute I do this, I will end up with the salvage value. Try that. Voila. Okay. So isn't this neat, right? Of course, some people may not find this neat, or some people may still wonder what's going on. Well, look, if you have been following watching the video and following what's being done, and you practice it on your own as well, then this is very easy. It's not terribly difficult stuff, and especially compared to uh, the time value of money, everything after time value of money is more like, common sense based, right? Okay. Maybe, the only thing that was difficult was, in the if command in the LIFO FIFO uh, in inventory valuation. But other than that, uh, it's all, quite doable, right? Makes sense? Now, so what about well, this partial year depreciation in the rule of 78 uh, took some time. I mean, it took almost an hour to go over this, but there's a uh, very useful lesson you can find in this, right? We still have one more model called, declining balance method. So we're going to talk about that in the next class. And there's one more method, but that one more, the last method, the third one, I normally don't talk about the third one because the third one is called, uh, modified accelerated cost recovery system, or MACRS, modified accelerated cost recovery system, which is not a mathematical method at all. It's a um, predetermined rates, already predetermined rates already given by IRS, and all you need to do is just follow that rate. So there's nothing mathematical about it, right? But so normally I talk about only the rule of 78, or sum of the digits method, and declining balance method. Uh, but we'll have enough time to even talk about the modified cost recovery, uh, accelerated cost recovery system. Okay, so that's it for today. I'll see you guys in the next class. Okay, thanks for watching. End of video.